Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, September 11th, 2020. What I want to do here is we'll do a quick update on the whole video stay focused on the equity markets. No more adding gold or commodities in there if it's going to be more than a 20-minute video. So I'll keep it limited to the equity markets. I've been covering a lot on the short-term outlook, near-term outlook, and what I'll do in this one is I'll touch on that as well because that's important. We have to look at levels that may determine the next longer-term trend if they're taken out. But I also want to cover the long-term charts and look at the FANG stocks. That's something I haven't done in a little while here. So starting out, just to kind of recap, my thought process and what is some of the most important developments in the market, other than the big monstrous rally we had off the March lows, is the extreme sentiment readings that we hit recently. I've covered that quite a bit lately, so I'm not going to go into detail, but I'm picking this one here, one of my favorites, CPCE, the put-to-call ratio, equity-only put-to-call ratio. And again, we've been at, really for decades now, over a decade, unforeseen, persistently low readings, meaning excessive call buying over put buying, and it shows the extreme bullishness. And again, without fail, you go back for a decade or more, anytime you've hit this line right here, the red line, you've had sizable corrections in the past. And so this, coupled with economic conditions and what's still going on with COVID, could warn of a very substantial drop. So we'll get to the charts to see what that might mean if and when we get it, and of course, what triggers that, what stops the current trend. I've been talking about that for a while, and I'm sure some others have as well. The disconnect between economic reality and the stock market. So let's get into the charts, and we'll kind of look for some levels to identify where we might be headed longer term. And one of the things that is leaning me towards more downside from the recent correction that happened, I think we're in a little consolidation phase right now. Oversold, we had an oversold bounce, and whether it's over or not, again, that's part of this video. But what I've seen in this, or have not seen, is a tremendous amount of fear. This rise in the VIX, we positioned long ahead of that, it started to occur before the market even topped. And since the market peaked, we had the biggest correction in months, the biggest correction since, I believe, since COVID. At least in the tech-heavy QQQ, and that's where all the hot air has been lately. We had an 11% drop in just 3 days, and the rise in the VIX, again, it was mostly right here. The VIX had already started moving up while the market was still going up. This rise to me is not commensurate with the drop. What it tells me, or at least my interpretation of this, just like the CPC and the CPCE, those put-to-call ratio indexes, they did not spike up to levels in the past that have preceded the end of previous corrections. So this tells me there's still no fear, very little fear, let's say, in the market. And as I said the other day, I still think this is an objective entry. This is about where we entered the trade before, went up over 20%, and I still maintain these targets. This would mesh with another leg down in the market, and that's part of my analysis here. So, whether we go down or more or not, here we had something similar back here before the COVID hit. This warned of the big COVID drop, or a drop in the stock market, and you had the initial surge up, probably coincide with a little correction, a little pullback in the market, followed by a push to new highs, and then finally the VIX exploded. So I'm favoring something along those lines. However, I don't think it's going to take this long. We'll see. Hard to predict exactly when, but I do think the risk reward is attractive on VXX. It's all about risk reward. How much money are you risking to make a dollar? You don't want to risk $1 or $2 to make only $1. In this case, let's just say that third target is hit. From where we're at now, you're talking a move about 63%, 65%, somewhere in there. So you could certainly allow yourself a much wider stop. If you allowed a stop down to the suggested stop there, that's about 7%. You're talking almost a 10-to-1 RR, which is phenomenal. A good RR, risk reward ratio in a trade, is 3-to-1, meaning you risk $1 of loss when you enter a trade. Buy a stock at 100, you think it's going to 130, that's your price target, so you set a stop loss at $90, and therefore you lose, $10 if you're stopped out, or you make $30 if your target's hit. So I just wanted to reiterate that I still like this right now. It's much more objective to add here. In the first surge up on the initial tag at T1, that was an objective place, if anything, to take profits. That's what these targets are for. They represent areas where a reaction is likely upon the initial tag. So again, I just wanted to speak to the fact that yeah, we did get a spike in the VIX, but considering everything else that's gone on, and when I'm looking at the put-to-call ratios, again, I don't see enough fear in this market, and that is indicative of a market that could be poised to come down pretty hard very soon. Okay, and a quick recap on the 60-minute charts. I'm hyper focused on the NQs, Nasdaq 100, QQQ, NDX, all the same. This was the sell signal right here. That's where we got a leg up on the drop. That was our objective short entry. We came down here. We had this bear flagging action. That one played out like that. It was kind of a two-legged down thing. That was a little quirky. But then most recently I highlighted this potential bull flag yesterday morning, and those started to play out. And then as I was doing the video and they were starting to play out, we started to reverse and lose steam. And as I said, that's not indicative of a bull flag pattern. A bull flag, and I highly suggest Googling the term. You'll find it everywhere online. That's a bear flag. Bull flag is you have an impulsive move up with a flag. Flag is always downward sloping. You can also have a bullish pennant. They're almost one in the same. Pennant just takes the form of a pennant like that, where flag looks like this. And then the third component is a move out, equally as impulsive, with a measured target being the distance of the flagpole added to the bottom of the flag. And so you can see when we reversed yesterday, and that happened during the video recording, that pretty much foiled at least an ideal bull flag. And then, as I said, you might consider a stop below the flag or higher. You could trail stops up, and we took that out. So that is, is it the end of the world? No. This trading has been kind of erratic and sloppy lately, but so far, there are signs that point to the fact that may be it, especially all the the hot air that was in this market, and again the lack of fear that I'm seeing right now. And we did stop, as I pointed out yesterday, both the 38.2% retracement levels on the Nasdaq 100 as well as the S&P 500. So that's something to note, that this bounce did meet I don't want to say that's the minimum bounce criteria, but that's the typical range I usually see, 38 to 61.8 on a counter, if it is a counter trend bounce, counter trend rally like that. Like this is the primary trend, first wave down, second wave up, and it was every bit of a tradable rally. I believe this was almost an 11% rally in the Nasdaq 100 futures, NDX, a little less than that in the S&P 5 or in the QQQ, because the Nasdaq 100 11%. I'm sorry, I meant to say 6% there. I don't know where I got the 11%. It was a 6% rally, high to low, in the Nasdaq 100 futures. A little bit less than that, I think 4.5 or so on QQQ, because again, QQQ doesn't trade around the clock. Some of these trades came, during the night or after hours. So that's it. We want to take a simplistic view, maybe a bit overly simplistic, but I like to look at things this way. Here's an area of consolidation, right? We had this big drop, and everything got pretty oversold on the short-term indicators. We had the bullish divergence and everything else, and this is a battleground between bulls and bears right now. They're slugging it out. Dip buyers are stepping in, buying Apple, buying Tesla, whereas short sellers and longs that realize, hey, maybe the trend's finally broken. It was a great trend, but again, this correction is different from any others that we had. So we'll see where this is resolved. And the thing about technical analysis, what I love about it, it's like looking through the charts, to me, is like trying to look through a glass wall, and it's obscure. You can't see clearly through it, but what makes stocks go up and down, the stock market and individual stock, it is all simply supply and demand. If there are more buyers on the sidelines, I mean willing, actionable buyers that are ready to buy. You said, maybe yesterday, hey, I'm going to look to buy Apple on the dip, or I want to buy Tesla or QQQ. If there are more buyers than sellers, maybe you had Apple and you're saying, you know what, I've had Apple a long time, I'm up a lot, and I'm going to use this dip. I don't like what happened the other day. I'm going to take advantage of this bounce to get out. And so simply, if you have more buyers than sellers, here's your pool of willing buyers on one side, forget about the chart there, and here's your willing pool of sellers right there. That's going to drive stock prices up. So we'll see in the very near term, and that's of course a very fluid dynamic thing there. In the very near term, we'll see. Will the sellers overwhelm the buyers? And so here's our area of recent consolidation, and break below the recent lows is most likely to open the door to a new leg down. I'd have to imagine that. You should have a lot of stops here. People that didn't get shaken out. Let's say you were bullish and long, own Tesla or QQQ and Nasdaq, and you didn't get shaken out there. Well, why would you be shaken out right here on this pullback? You already went that low. So it's only logical to think there's stops placed below that level. Likewise, we've had a couple reactions there, and it's only likely to think maybe short sellers would have their stops right here. And if we break above there, that might bring in some more longs that are bullish and saying, oh, look, it looks like the worst is over. We just made a new high. So again, this near term are the levels that I'm watching here. I wish I could turn off these trend lines on this chart. I can't. Some of the charts I can toggle them off, but let me show you something that could be near term bullish. I'm not a huge fan of head and shoulders and inverse head and shoulders on the short-term time frames, but I've seen so many traders post them in recent years that you have to think it doesn't matter. Originally those patterns were meant to be recognized and traded on daily and weekly time frames, forming over a period of weeks or even months. But with that being said, I've seen quite a bit in the shorter term time frames. So we have here what could be a potential inverse head and shoulders. This is your neckline right here. That's a break of that triggers a pattern. That's supposed to be an L. Bear with me. Your right shoulder right here, your head, and left shoulder there. So, and that would also coincide roughly there with a breakout above there. So again, bullish. If that happens, those original upside targets that I had could be hit, and that's a back test of the trend line, and or this resistance zone up here, and a minimum bounce target that originally had of 11,728. But with the foiled breakdowns of those flags yesterday, and we also put in, I didn't point it out in the video, but I noticed that we put in a small divergent high right here on the 60-minute charts, and then we went on to take out this trend line right here. So that's where we're at, and you can see this was a former support, still resistance level, and we're below that. So very near term, pop that, we're probably going to run up there, and then again pop that, that's going to be near term bullish. But this is the way I'm leaning. I think there are a lot of trap longs, and again too many longs versus not enough shorts. Sentiment reached an extreme. The put call ratio tells me that. You can look at things like short interest and all that, and when you don't have, when the boat's loaded and everybody's long and bullish, there aren't as many willing buyers left on the sidelines. Who's going to buy once the last long or bull has bought his or her share? So that's it. I don't want to spend too much more time on the short term. I just wanted to hit on it. And then ES that we have here. Let's see what happened on ES. Just to kind of recap 60-minute futures. We did put in the divergent low, and of course that made me bullish at the time, leaning towards a bounce, and we got it. And again, it was a decent tradable bounce all day long. Then we had what seemed to be textbook bull flag right there. It broke out, and that was again posted. And then during the video we failed it, and the breakout didn't go anywhere. And as I like to say, another reason that I've kind of flipped my stance, is to upside the rally may be over. Why I did that yesterday is fewer things in trading are more bearish than a failed bullish setup, a breakout, a failed bullish breakout. And that was a pretty clear, to me those flags were pretty clear and visible, and the breakout was impulsive, but then we got checked with a pretty impulsive reversal. So I can say definitively that they failed. That's not gonna. They're no longer valid. The pattern's no longer good, and it was a failed breakout. And so same story. And you can see here with ES similar. If you want to kind of monitor that potential inverse head and shoulders pattern, it'd be like this. Here's your left shoulder right here. I'm making a mess of these drawings. Your head, your right shoulder. And again, the bottom line is we need to clear out, break above or below this recent trading range to determine the next near-term direction. And this is the way I favor. I'm positioned that way and think we're going to go to the downside. And then I'm going to get to some longer-term targets now. All right, let's get to SPY and QQQ first, since a lot of you don't trade futures. Daily chart, what happened there? We had the break of the primary trend line right there. That's probably the most significant thing, and that's the other thing. We're on a sell signal, and I talked about this yesterday. Even though my upside targets were a little bit more, when we hit the highs yesterday, my minimum bounce target was only about a 1.5% above on QQQ, I think it was. Not worth it. And I'm not going to try to squeeze out an extra 1.5% in risk another big downside. So we got close enough, in other words, and like I said, we hit some minimum fib projections, things like that, but we had a powerful sell signal. We had the first decent sell signal. I had these lines color coded blue, and I had this one blue, waiting for these to break for months, and we still haven't broken my the third 318.30, but we did break the blue trend line, and that's the first sell signal that I've seen on the daily charts, daily time frames, in many months. So that's it. And so period of consolidation, we zoom in nice and tight. I mentioned potential bear flags. They would have looked like this. That's how they were yesterday. In other words, impulsive move down, bear flag. This is your impulsive breakdown right here. So if these are bear flags, that's still a big if, we need to see impulsive selling. We need to see, probably by the time you're listening to this video, we need to see the markets turn around and take another impulsive leg down. Because this is not, if we go sideways like this much longer or bounce up, it's not going to be the ideal scenario. When you have a bear flag, you want to see an impulsive breakdown, which we got, that red candle right there, the bottom part of it. And you want to see follow through today. And so far today, we're not seeing that with the SPY up 0.37%. But if we turn down soon, that would be fine. And where they project to, I think I covered that yesterday when I first highlighted these. The measured target, take the widest part, or the flagpole, add it to the top of the flag, right down to that 318.30. So again, I want to reiterate, there's a swing target. There's support there around 326.70. But if we do get the impulsive drop today that I'm looking for, or I'd like to see, remember, the nature of a bear flag is that the move down is nearly equally as impulsive. So my point is, I won't try to game a reaction or a bounce off the initial tag at 326.70. I'd rather hold out for a move down there to 318.30. And then on QQQ, same thing. We look at QQQ. I'm zoomed in a little bit here. Let me zoom back out. Excuse me. Primary trend line right here. There you go. Sell signal. We had a 6 save that day. The following day, impulsive. We gapped below it, had a solid close, and a near back test, close enough. So you can look at it that way. That was originally my bounce target, was to back test the trend line. Well, close enough. And one thing I often talk about, if you've been with the site for a while, you heard me say this: if all eyes are looking at one level, if everybody's looking for a back test of that trend line, guess what? Probably not going to happen, because too many eyes are watching it. Some people are going to step in early, and so again, close enough. Same reason that if I have a long trade and the target is bouncing to, and the resistance is 275.05, I'm always going to set my sell limit order slightly below that in case this happens. So again, for all intents and purposes, we didn't make a full back test, but close, darn close enough. And I wanted to say that the flags. And again, this is the QQQ, the almighty Qs. There's your flagging action. Again, that would be a drop yesterday, a breakdown through it. So far we're holding today, but if we can dump soon, then that should take us down and hit either of these targets. I could give you the measured target. I'll just have to play it by ear if we even break down. It could be moot. Maybe I get the video out and we continue up today. Who knows? But if we do, that's going to project down to around that 251.24 level, which is, again, that was comparable to the level I was watching on SPY back here in the month of July, which we never took out, and that would take us around there. So there's your near-term swing targets again, and what to look for if you don't want to jump the gun, wait for a break of the recent lows. That should do the trick, and obviously you want to see some impulsive selling followed up. One other thing before I move away from QQQ, on the 60-minute chart here, again, here is my primary trend line, clearly broken, nearly back tested. There was that divergent low that I said was only existed on the RSI. We never had it on the PPO. Now we might soon. It's something to keep an eye on, because if I extend out these lines, look at this. We make a marginal new low. We could put in, and this is where I really like to reverse, to cover shorts and go long in a trend reversal on positive divergence on the 60-minute chart. But the daily charts, I think, are overriding and everything else here. There are times that divergences don't play out, and that's the tough part in this game, is deciding when to shrug off bullish or bearish technicals, indications that you might bounce, and when not to. And of course, trying not to let it be confirmation bias, trying to do it from an objective lens. So I'll watch that. If we have a marginal new low and we reverse impulsively, look, we're going to have the divergence, and maybe then we go into back test. As of now, I'm leaning towards that more the breakdown and the more impulsive leg down if we get it, and these divergences may get taken out. But what I wanted to point out to you is this. There it is. We broke down and put in that small divergent low. We did have that nice bounce there, certainly a tradable bounce, and already moved down. So it really, these divergences didn't play out for too much. And I like to assess, I always talk about this, once we get a move, whether it's a breakout or a correction like we're in now, I like to assess the price action as we go. And the fact that we had those 60-minute divergences clearly across the board on all the indicators on the futures, and it only played out for a relatively small bounce followed by another impulsive leg down, tells me there are a lot of sellers and trap longs waiting on the sidelines. Otherwise, a 60-minute bullish divergence on the futures, give me that on a bullish trend all day long. That's usually the start of the next major leg up to new highs and beyond, and that wasn't the case. So in other words, we had what was a pretty nice looking bullish setup recently, and they sold into it just as soon as it started to get some traction. Again, that was yesterday when I was doing the video, and hence the reason for my kind of shift from looking for a little more upside to saying, hey, this might be it. And as mentioned yesterday, if you caught that video, this is the flagpole, the impulsive move down on QQQ. And there's your measured right to my fifth target. So that's, I called it potential, but I started to reiterate that as we went, saying, look, instead of potential, that's likely to be hit. And so you kind of take a step back. Here's your, again, flagpole, bear flag, and this shows on the daily as well. There's your daily bear flag. There's the breakdown, started to occur yesterday. Remember, you had that red candle yesterday, went down through there, and so if we get this, we take out the lows and we start falling impulsively, this is your likely price target. What does that do for you? Well, it's going to pop the VIX almost certainly, and it's going to give you about another 8% drop in the Qs right there. So that's the there's your trading ops. How do you trade it? If you're of that mindset, short if you're already short, or if you want to wait for the break, go ahead, and then once it breaks down, set a stop. If what was that 8% plus drop, let's say, so you do a 3% stop loss from wherever you enter, and then you can either trail it down or just leave that stop in place. Once it gets profitable, maybe lower your stop to entry, and you can cover there for a bounce, or I'm about to roll into the longer term charts and we might get some more. Let's see. We got it first. So far this has just been what I'm viewing, and probably others, a healthy pullback. I think even a lot of the bulls were calling for a correction, saying, look, this is a little too much, a little too fast. So there is that camp right there, and I have to acknowledge that so far you can't get so excited over a 7-10% correction in the market. Okay, one more thing on the 60-minute chart. There's actually, a lot that I wanted to cover on this video. I've been studying the charts quite a bit in the last couple days. 60-minute PPO. I use that as a trend indicator, and what I like to use is a 9 EMA. I've talked about this for you guys. If you've been with me, you've heard it many, many times. I'm going to turn this line off. There's the PPO line, and I'm going to leave the signal line. That's the 9 EMA on the PPO is your signal line, and I find that to be a pretty accurate trend indicator. Simply put, often I'll use it at the 0 line, but on every security, each security is different. So on QQQ, you'll notice here's the March lows, the bottom. And so I've had a line at about negative 0.57. And you can see that the way it works, and it's pretty simple, when the PPO signal line is above that line, as it was here, the trend is bullish. And not only that, an additional benefit is the line, once it crosses above or below, often acts as support or resistance. When it's above, it acts as support. So pullbacks to support, and you can buy those pullbacks to support during the trend, and it keeps the trend going, right? Once you cross, the trend has changed, and we have now the first cross again since the bottom was hit. We have the first cross, and we're solidly below that level, and we're back testing it from below. So this meshes with my scenario that maybe this was a bounce, or maybe a little more. Now we could continue, come down, back test again, and then another leg down. You can see here, even pre-COVID, the pre-COVID drop, I should say, it was doing a good job of saying the trend is up, and then right there, boom, there was your heads up early on, right after there. Now we had sell signals triggered, using the same things that we did here, trend line breaks, divergences, everything else. There were, we were short there, were able to get a heads up on that, but that confirmed the trend changed. And you had one little whipsaw there, and even if you traded this just religiously, in other words, you shorted or got out of your longs when it crossed down, you covered and got back in there, all you would have done is just, got in here, got out real quick, but you would have got back short again, and you would have stayed short. It failed on the back test there and didn't cross to right there. So right about the bottom, and that's also when I gave a buy signal on the Qs back then. Here's my 60-minute chart of, and there was a downtrend line, there was our bullish divergence, positive divergence, there was our breakout, and that told us that the a bounce had started, and position for it. So I just wanted to say that that trend indicator is bearish right now. You can look at the same thing on SPY. Levels might be a little bit different. Let's see how I have it here. Yeah, about negative 0.51. SPY has crossed below that trend indicator. We had a little whipsaw after COVID right here in the that indicator. Again, my focus has been on QQQ, but other than that, it's done a pretty darn good job of saying, hey, when the PPO signal line is above there, the trend is bullish, and when it's below there, the trend is bearish. And so, look, for the bullish case, if you are bullish, long right now, or looking to get long, this crosses over as well as the PPO and QQQ, and we take out those recent highs and the recent trading range in the last few days, and yeah, that's going to be it's going to put this, at least this indicator, it's not a be-all end-all, but it'll put it back on a buy signal. Could be a whipsaw, or maybe not. Maybe this was the whipsaw. Okay, to wrap up the video, I'm going to rifle through the top holdings, the largest stocks in the Nasdaq 100, because they represent, obviously they have the largest impact on the index. So we're going to start out here with Apple, the sole member of the $2 trillion club here, and it's a long-term chart. This is a weekly chart. That's all we're looking at right now, weekly time frames. And this shows you, the big moves. And if you can sit back patiently and wait for these, it doesn't say DH here, but it should. That's divergent high. That correction, I didn't measure it out, but I'm going to do it for you right now. Off that divergent high, Apple fell about 64%, and it, ended with a divergent low. So if you're really, a trend trader, and you can sit back, capture the bigger moves, these are the trends you want to trade. 65% drop. Divergent low, you get in long, and then along the way you had, it doesn't look like much, these little corrections, but they're measured out, 26%. And again, it's off the divergent high. If you see DH, that's where the divergent high was, and I measured the drops, 26%, 15, 16, divergent high, 45%. That ended with a divergent low right there, positive divergence. and that led to that rally. So you cover shorts, you go long there. Divergent high, 32% drop, followed by, before all said and done, it was a 34% drop off that divergent high, and it ended with a divergent low. So again, it's watch, rinse, repeat, kind of long-term stuff, but these are your primary trends. And they're all identified in advance, at least these were, with positive or negative divergence. That divergent high, 39% drop. So this has been a secular bull market in Apple. And yeah, it doesn't take a genius to say, oh, I just put my money in Apple, not do anything. Yeah, and you would have been fine if you rode that out. But you felt a lot of pain if you rode out a 45% drop, a 34% drop, a 39%. And most people, most investors would have been shaken out along the way. That was 60-something% there. Again, and so, and also remember, secular bull market, but this was powerful 60 plus% bear market back in 2000 from '08 to '09, or to 07 highs to '09, and sooner or later there will be a new major bear market in Apple where the stock drops over 50%. And all I can tell you right now is I had that. Forget what that was. Oh, that was a split markers. I covered that before. How splits. Went into this in detail. After an extended bull run, multi-year bull run, splits often mark the top in the stock. That was it back in 2000. The stock from the time it split fell. Before all said and done, into a multi-year bear market, you would have been, losing money for 3 years on Apple and been down 80% if you bought the split, roughly. There was a split there, and it came relatively early on in a bull market and not after such an extended run. There was a pullback. You did, if you bought the split, you did go down. Again, weekly chart, every candlestick is a week. You dropped about 21% after the split. So it was a buy the rumor, sell the news thing there. Right here, that came after one of the biggest drops, or the biggest drop up to that point in the bull market, a 45% drop. So a lot of the excesses were washed out of Apple, the excesses, sentiment, bullishness, all that. And a 7-1 split, but either way, the stock went up from there. So in every instance but that one, and which again came on the heels where the valuations were proper, the bearishness was washed out, the excessive bearishness, or I should say bullishness, I'm sorry. This time around it's different. This split is coming at all-time highs after one of the strongest bull runs in Apple, and again, so far it has marked the top. As I went over this before the split even occurred, that may be the case, and you can see so far it's a by the rumor, ramped up on it, knowing it was coming, sell the news kind of thing in Apple. And then again, the divergences and all that say that all we need to do is take out this trend line here. There's your trend line on Apple. We're getting close, and we haven't taken it out yet. So when we do, how far are we going? Well, let me just say it's going to be measured in double digits, not single digits. So we'll kind of cross that bridge when we get to it. I'm going to go through the rest a little bit quicker because I talked about the split there on Apple. Amazon, primary bull market uptrend line, blue, is still intact. This is one stock that never took out. There's a 2008 lows just before the '09 bottom. Remember, a lot of tech stocks and the Nasdaq 100 bottomed in late 2008. Every other index and most stocks bottomed in March '09, but tech bottomed then. And Amazon's above trend. Now, however, like everything else, when you have a bull market trend line, at bare minimum, the stock's going to come back to visit that trend line from time to time, and that would be your next downside target. And it aligns with this price support target there. This one's just been, PPO's rolling over. Look at that. You have a high level bearish PPO crossover about to occur. That often marks a trend change. I'm talking right here. And there's Amazon cracking below trend right now on this weekly chart. It already has cracked below trend. Microsoft, again, you're looking just years and years. You can see the divergent highs, the drops, 25%, 21, 15, 19. And you can see the negative divergence in place right now, which would indicate nothing less than these previous double-digit drops coming soon. And you can see this would be a target zone down here. Facebook, let's see, I haven't updated this one in a while. The trend line's not super well defined. I pull it just like that and say we're just above trend on Facebook right now. Need to break this trend line. Alphabet, GOG, one of the share classes right there. I don't have a great trend line, so I don't want to really force one. I do on the daily chart. You can see this is what it looks like. I have a trend line there that has been taken out and back tested. weekly chart right there. But again, this one just continues to build these divergences right there, indicating a correction is coming, and it's going to be a pretty big one. Tesla. Now this one, Tesla, was great trading vehicle. Highlighted these trading range back at the time. These two trading ranges. You could buy at the top of the range, sell at the bottom, or buy at the bottom, sell at the top. Long, short, long, short, long, short. And when it broke out of that range, it went up here, bounced around in this range, went back to the previous range, and then finally made a breakout, and that was it. Once it broke out above this trading range right here, the 77.52 line, that's actually where it broke out. It rallied up, made a perfect back test. Again, that was the top of that trading range, and then off to the races. One of the most overvalued stocks out there in the Nasdaq 100, the top big names, and you can see just a big old wedge forming. This is a big old rising wedge, and so if and when this goes right here, and Tesla, as we all know what happened since the split, you can see very clear negative divergence. Let's just measure out the last couple times we had divergence. We had a divergent high right here. Let me turn off the lines. I'm going to show you before I turn off the lines so I can measure them out. Right here, that was a divergent high into this drop, and then right here, prices were making equal highs in that trading range, but the indicators were making lower highs. That's negative divergence. So here, and let's turn off the lines, measure it out for you. This one resulted in a drop of from the divergent high down to the low about 50%. And this one was about from the high to the low, that was right there, about 54%. I don't see why I would expect anything less than that right now, and that would take us right to that reaction high. We'll turn back on our lines. That's it, 202.25, give or take. There's your target for Tesla. Starting to crack below the wedge, but we're right there. It depends how we close the week. If we don't have a solid close this week, they'll keep us guessing and may come next week. Let's look at the daily chart, see if we can glean any clues. Yeah, I don't have a great trend line on the daily chart of Tesla, but that's the one we'll use right here. You can see it from about the lows back in, the post-COVID lows back in March. Draw a trend line up there, and that's what you want to watch. NVIDIA, one of the leading semiconductors, big divergences building, cracking, it's poised to close below the trend line there, triggering a sell signal on the weekly chart. If we close anywhere where we're at, well, we're close to the line now. We rallied back right up to the trend line. So this one we're probably not going to know until next week. If we close that close to the trend line, remember this is candles hollow, meaning we're at the top of the body right now, right there, 498, 499. We need to print, a close down closer to the bottom of that candle. It would take a pretty big dump today. It's possible, but we probably won't get our sell signal until at least next week on this one if we get it. Adobe already broke down, back tested there. And that's Netflix. I haven't updated this one in a while. Let's see if the chart loads. Yeah, there it is. There's my trend line right there. A little sloppy. There's been a lot of, the Fed came in and just distorted the charts, in my opinion, by, backstopping the financial markets, backstopping the credit markets, flooding the system with liquidity. But there are enough pretty nice trend lines that I've drawn, and again, the divergences don't go away. Those are not distorted. What the Fed did is they just I call it Ursa interruptus, meaning a bear market interrupted by the Fed. I believe that a bear market started back in March, and you can look at measures like the equal weighted S&P 500, which we're at here, and that tells you that despite the major indices, remember QQQ or Nasdaq 100 is not a representative; it's a tech index. You look at the S&P 500 and you look at the Dow, and if you look at the equal weighted, it never recovered. And there's a clean. These are clean lines, and these were, to me, very clean. There was a bull market trend line there, and some people even think that's kind of when it ended. Now, you can't say the bull market ended if you made new highs. Technically, the Fed's just been pumping the market up. They've started pumping it up back then, coming in with flooding the system with liquidity and zero interest rates. When the big fourth quarter dropped, they took it up to that high. to me, that marked the end of the bear market there. And on the equal weighted S&P 500, so far it has. And so this is a bear market rally, super sized at that, no doubt about that. But it's still well below the highs on the equal weighted S&P 500. And again, I wish I had a better trend line to draw. This is the trend line I have on the equal weighted, but we'll see what happens here. If we start headed down, then it's just like I said, probably more downside to come, and I won't even get into targets now. But oh yeah, you can trade this. They have an ETF for that. I think it's RSP. That's the equal weighted Nasdaq 100 ETF, just like you have QQQE for the equal weighted Nasdaq 100. And we're going to wrap up here. I know there's so much I like to cover when I go over these charts. It just get me talking. I can't stop. Just like the Nasdaq 100 and S&P, you see the PPO rolling over. You can see clean separation. It's turned down. It is now headed down. The PPO line, if you zoom in real close, the blue line has crossed down. It has a negative slope right now, meaning it is pointing lower. Poised to make a bearish crossover. There was the last bearish crossover right there. That's what happened. And again, I look for these high-level crossovers. I stay away from using these crossovers as sell signals, whether they're bullish. There's a bullish crossover. Don't forget, they work just as well, and that got you in there. You want clean separation. There was clean separation in the lines there. There was your bullish crossover. There was a bearish crossover right there, clean separation. You had a very profitable, sizable correction to trade. And it's right here. When you're in a flat trend, prices are flat, these indicators are whippy, and you stay away from them. So again, I like clean separation, like here to here, here to here, here to here, and that's what we have right here. So you can also look at that visually by putting a PPO histogram, and I call them the hills. You want to see big green hills like this. When you get those big green hills, when it crosses down to red, there's your bearish crossover. When these two lines cross, the histogram will go red. And they're also trend indicators. Went red, told you get out or short right there, stay short to this point, and it captured most of that. Here it said get long, stay long, and there it is. So there is a green hill, and you had a bullish trend. Nice clean separation here. A nice clean rally, and again, nice clean separation there to find that downtrend. So these are the things I'll be watching for in the coming weeks. It's a weekly chart. We're not going to see that bearish crossover this week, but we can see that the trajectory right now of the PPO, once it rolls over, it usually continues that way. These are momentum indicators, so it shows that the momentum has been slowing in the rally and actually has kind of rolled over now. And so that's that. Okay, I will wrap it up here. Just watch those short-term levels. That's that kind of short-term stuff, and if that starts to play out, whether we get a rally to the upside, that could maybe take us up to hit those targets I laid out earlier in the week, those potential bounce targets, maybe more. And same thing, if you're bullish, and I'm laying out the case to maybe short here, you want to go long, same thing, go long, set your stops, you determine where that stop is. The levels that I give you here are key, what I believe to be important support and resistance levels. So if you're a bull, you can set your stop a little bit below those support levels that, if taken out, should trigger the next wave down, and then let it ride and ratchet your stops up along the way. And likewise, if you're bearish, set your stops strategically or tactically, just above the resistance levels that should, quote unquote, should cap any kickback rally. All right, we'll wrap it up here. Long video, but I wanted to get a lot out in this one. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.